Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
G'day everyone, and welcome to another episode of What's Not Priced In. I was missing in action last week. I was over in the States for a week on a business trip. It was an excellent trip. Probably tell you more about that in future episodes. But for today, we've got a special guest. James Cooper, our resident commodity analyst, is joining us. James, how are you, mate?
Good, thanks, Greg. Thanks for inviting me along.
No worries. Well, Kirill's out of action for a couple of weeks, and always good to have fresh guests with new perspective. And being commodities analysts, commodities have really felt, I guess, the brunt of a lot of the selling when there are liquidity issues in the market, especially the junior miners really take a hit. But before we get into talking about commodities in general and some of the bigger themes that are going on in the markets, for Fat Tail Investment Research readers and subscribers, they'll be well aware of your background. But for those who are listening who might not be familiar with who you are and where you've been previously, maybe just give us a brief introduction to your bona fides for commodity investing, mate.
Yeah, sure. So I've been involved in mostly mining, a little bit of finance, but all related to mining for about 15 years. And a lot of that has been in the sort of small cap juniors, like the explorers looking for new deposits. But it's also been in the later stage producers. So I've really been involved in all the different phases of the mining life cycle. As well as that, I've had the chance to look at different projects across different commodities, and that includes things like copper, iron ore, zinc, and gold. So yeah, that all these experiences, I guess, have enabled me to sort of help investors target stocks with strong fundamentals, I suppose, identifying what makes a good company, and I think we'll probably tap into some of those questions later on.
Absolutely. And one thing we probably didn't point out in that introduction is that you are a former geologist, which is where you've got all this experience across the range of different commodities and different projects, et cetera, et cetera. So maybe just quickly tell us what maybe continents you've been on. Where have you seen the most action in terms of digging holes in the ground?
Yeah, so mostly in Australia. So South Australia, Western Australia has been the bulk of my experience as a geologist. Yeah, sorry for not pointing that out earlier. It was also back in 2010, I got the chance to work in Zambia, and that's just sort of a Central African type country, just bordering Botswana to the south, and you've got uh, Congo to the north. Now, this is a really important spot for copper. It's got the copper belt running through the northern part of the country, and that's where I was stationed. So on the edge of this traditional copper belt, sort of looking for essentially an extension of this decades-old copper province. So that was with a company called Equinox Minerals, and this was really one of the darlings of the last mining boom. And it was taken over while I was at the company by Barrett Gold, and that was a really interesting time for Barrett because it was their first sort of foray into something other than gold. Before then, they were the biggest pure gold miner in the world. So our projects stood up for them, and yeah, it was great to be there from the early stages with Equinox, and then all the way through with the takeover with Barrett. So seeing these mergers and acquisitions is quite a common part of life in the mining industry.
We'll be talking about copper in a bit more detail later on in the podcast. And if you are watching, we're going to get into I guess a range of different commodities. We'll be talking about lithium, probably touch on uranium, gold, energy, all those sorts of things. Copper, I know, is a big focus of yours. But before we do that, let's sort of take a step back and look and see, I'd like to get your view on where we are in the commodity cycle, because a lot of people ask me this question, and my view is that we're in a supply constrained commodity world. But you say that, and prices have been falling relentlessly
Mm.
throughout much of 2023. And my rationale or justification for that is that, okay, we're in a cyclical downturn, not necessarily a secular downturn. And I consider secular downturns to be where there's just an oversupply of commodities. They're pushing prices down relentlessly, even though the demand story might be okay. But in this case, we've got supply concerns longer term, but we're just in a cyclical downturn. And that's purely to do with the macro situation with higher interest rates, which push through to higher real rates. And that's something that we talk about on this podcast a lot. Higher real rates are putting pressure on all sorts of asset prices. But yeah, enough about what I think of it. What's your sort of take on where we are in the bigger picture commodity cycle?
Yeah, so I tend to agree. So if we think back to the last secular downturn in the industry, so that would be 2016, 2015. And that's when the big large cap miners like BHP and Rio Tinto, all across the board really, stocks were at these multi-decade lows. But also that was because commodity prices were also hitting major lows. I think gold hit its final low in late 2015. Copper hit its major low early on in 2016. Um, so it was just a point in the cycle that really marked the very bottom of that secular bear market. And since then, I think we're seeing strong prices in across commodities. So gold, copper, nickel, all these commodities are up 80 to 100% from where they were back in 2016. And I think that just highlights that there's still this strong fundamental strength in the industry. And the fact when we look at these big cap miners like BHP, and they're only trading somewhere like 15% off their all-time highs. And I think that's because commodity prices are still relatively high. Um, but then, of course, we've got the junior market, and 2023 is really been a brutal year for the juniors. And I think, yeah, interest rates, cost of development is really starting to hit some of these stocks. But if we think about the long-term demand fundamentals, which are still there with the green energy transition, I mean, governments have put billions, perhaps close to trillions now to make sure that this trend does happen, whether it's for better or worse, we won't know. But this trend is underway, and I don't think that momentum is going to shift. So when we think about the amount of supply we need to keep this momentum of green energy transition, there's also signs of some emerging growth in some emerging economies. So this is also bullish for commodities over the long term. Um, so I think it's really important to think that the long term setup is still there, and then to maybe think about where are the opportunities. And I think that is with the junior mining stocks.
Well, you just pointed out there that companies like BHP, Rio probably to a lesser extent, but very, not too far off their all-time highs. Obviously, that's to do with iron ore price, which has probably been one of the strongest commodities if we separate out the energy sector. Iron ore has been consistently strong. It's pulled back a few times, but it's then always bounced back up, even though there's been concerns around the Chinese economy and around the Chinese property market. Uh, is I guess in trying to work out why there's such a separation now between those large cap stocks and the juniors. Do you think it boils down to the fact that the large caps have already done the bulk of their investment? They're in uh, cash flow generation stage. They don't
Mm.
really. Yes, they do need to reinvest in order to continue to grow, but they're not making these significant capital expenditures relative to their market caps. Whereas at the junior end, they might have drilled out a good resource. There might be a lot of value in that resource, but they still have to go to the market and raise the capital. They still have to go through development risk. And when you have risk-free rates around the world that are bordering on, say, 5% now, the US 10-year bond yield's getting close to 5%, it just puts such a hurdle over the ability of these companies to generate or to raise that capital and go down that path. And I think now that the risk is really being priced in. So even though on the surface, yes, these are risky developments, for the first time in a long time, that is priced in the value of the equity, right? Because that's fallen to such an extent that the risk and reward now seems very, very compelling.
Yeah, absolutely. So I think if we look at the last commodity boom, the China-led field infrastructure boom, and that was very capital intensive for the big iron ore miners. So they're really benefiting now, having all the infrastructure in place to now just reaping the rewards um, from these multi-decade supply mines, which don't need much more capital
Yep.
investment. So that's just ticking off nicely for them with iron ore prices still relatively high. But the important thing for those producers, and not just focusing on iron ore, but more broadly with, say, copper and a lot of the other critical metals, um, these big miners have, you could say that they've been quite lazy because they haven't been putting much capital investment over the last 10 years, especially exploration, where they just see it as too high risk.
Yep.
Um, and this is one of the key drivers which sort of pushes us back into a secular bull market, because without that investment, without that new supply coming on board, that obviously sends up prices higher, and we just need some demand fundamentals to sort of create that surge. And I think that's kind of where the market is heading at the moment. It's still sort of ebbing and flowing as it gets out of the global risks, which is still impacting
So
the
devil's
juniors.
advocate question: um, if I'm an investor in the let's say not necessarily junior mining, but just in some of the developers, and I'm hearing these stories about, look, no one's investing in capex. There's limited supply. Um, Commodity prices are still well above their lows from the last secular bear market. And then you look at a situation like Chalice Mining, which I just pick on Chalice because it's probably high profile. It had significant gains throughout 2022 and into 2023. And just recently, it's just fallen like a stone. And from what I can see, and I'm not a specialist in this area, but from what I can see, it's a pretty fair resource. So could you maybe just give us your take on what the underlying resource looks like, and whether there's been any deterioration in that from announcements, and why you think the share price has reacted so negatively?
Yeah, I think Chalice Mining is really the poster child of what's wrong with the junior mining sector, and just not getting the investment that it needs. And so with Chalice Mining, if listeners aren't aware, that's probably one of the best discoveries in Australia over the last 10 years. It happened in the West Yilgarn region. So it's a Julimar deposit, and it's one of the highest grade of platinum. It's nickel and copper, so all the perfect commodities that you need for this sort of energy transition. Um, so what really set off the major selling was, a couple of months ago, it released its scoping study. And this is like a very early feasibility report, just to try and determine the economics of moving into development and eventually mining. Because at the moment, this is still virtually an explorer. It's just a very prominent explorer, and it did have a big market cap for an explorer. Um, but there are a number of features in that scoping study which investors shied away from, and one of it was perhaps maybe a commodity prices which were a little bit too optimistic, and that was given as one of the reasons. But I think it really comes down to just sentiment. So investors were still riding this company for the discovery potential, exploration. they weren't ready to feel the impacts of the costs involved in developing a mine. So there's I guess a mismatch between investors' expectations for taking a stake in these companies over the long term, compared with what it costs, and the risks involved in getting a producing mine.
I think it's worth remembering as well. And I do a lot of valuations of companies that are generating revenue and cash flows, and you can have some sort of accuracy where you come out with a valuation for a company that's got long-term history of dividends, revenues, earnings, all that sort of stuff, with the right, good assumptions around the discount rate and things like that, and the level of profitability. You can come up with an estimate of value, and often the market will disagree with you, and you get these divergences between price and value. But then they're generally not significant. But I think it's worth remembering in the junior mining space, where there's no revenues, there's no earnings, there's just a whole bunch of ground that has a whole bunch of potential, but also needs a fair bit of capital to go into that development risk in order to take advantage of that potential. There can be huge disparities between, I guess, the market's estimate of what that value is. And like you said, when sentiment's strong and when sentiment is at a point where everyone believes in a story, you're going to get these valuations that are quite extreme. And then, which we've seen really unfold over the past couple of months, the sentiment story has changed completely, and the market doesn't want to put much of a valuation on that. And I think that's where the opportunity is, to be honest. If you're taking a view beyond a few months, and granted, if you look at the charts of a lot of these stocks in the next few months, you probably don't really want to touch them. You want to wait for some evidence of bottoming. But if you've got to say a 2-year view, I think this is the time to really be looking at the good projects, the ones that you have a high probability that they're going to get the financing. They've got the good development teams. So maybe I'd just be interested in your views on that, and how you go about assessing quality of resource and quality of management team to develop that resource.
Yeah, so absolutely. So looking at the value on offer in 2023, I think if you have that 2 to 3 year time frame, it's definitely a great opportunity. Um, and whether that's an explorer or a developer, the opportunity there is perhaps something that we haven't seen since 2016. Even though that was a major low, the recovery coming out of that major bottom did see some strong price gains. And you see a lot of the juniors trading near back near back to these all-time lows back in 2016. But at the same time, not every explorer is going to surge, and not every developer is going to turn into an active producer.
Yep.
So you do have to be selective, and that's the beauty of picking stocks in a down market. So some of the things I use, and this is based a lot of from what I've done in the industry. So looking at different projects, what makes a company tick. And these are things like for the small explorers, looking at the drill intercepts. So is it high grade? Is it thick? Is it shallow? Is it close to surface? So these are all important factors to consider. Um, is this just going to be a sort of sudden spike in the share price because it's had a decent drill hit, or is this going to turn into something that could be an economically viable deposit? And there's a lot of factors which separate those two, and only a very few good drill hits actually turn into working mines. So as well as that, you really need a good team. So um, there is a skills shortage in the industry, so you need to be investing in companies that um, have, I guess, proven discoveries. So people that have made discoveries in the past, and there's not a lot of geologists out there that have discovered a decent deposit that has the potential to become a workable mine. So um, narrowing your focus on those companies really increases the probabilities. and the odds back in your favor. And another really important one, just given the market we're in, it's especially important, is cash in the bank. I think with liquidity could become a problem for some of these small cap juniors. And that sort of increases the risk of more stocks being issued and potentially your equity being diluted in the company. So cash in the bank, especially in this market, is critically important. Just because a company has a great deposit or a good management team, that's you're only going to see some the fruits from that if the company has cash in the bank.
So with your one of your services, I know you look at this particularly junior speculative end of the market. Without giving away any particular names, with respect to your current subscribers, have you got any stocks there that you're really liking at the moment in terms of ticking those boxes?
Yeah, there are a few, and we're just sort of slowly picking at stocks and waiting for a good time to get into them. Now, one of them is a lithium explorer. It's actually located in what we call the lithium triangle. So this is an established lithium province. It straddles Argentina, Bolivia, and Chile. Um, it's really a good opportunity because it's located next door to one of the majors. So that offers a lot of synergy for the big players to perhaps expand and look at taking over these neighboring explorers. Um, but as well, the company is a solid pick in its own right because it's getting good results from its drilling. Um, so it's got two potential tailwinds there, which is kind of what you look for, and is the luxury that you have in a down market. Another company we're looking at, or that we have in our portfolio, is it's a small copper explorer. It's located in Queensland. It's very early stage grassroots sort of exploration. It's using a technique, geophysics, and I'll jump into the geology weeds a little bit. It's a induced polarization. So this is just a technique for identifying or mapping the geology under the surface. And what it does is identify areas of rock that are high in respond well to sort of metals like copper and other minerals. Um, so it offers sort of a cheat sheet for the explorers. Um, Now, because it has such an effective targeting tool, which works really well in this area, IP, induced polarization, doesn't work everywhere. It can just put its drill rigs over the targets with a strong probability that it knows there is mineralization under the ground. So again, just stacking the probabilities
Yep.
in your favor as an investor is really the key approach.
You mentioned something there before in regards to lithium stock about it being near a major player. That would have to be something that you'd be looking at pretty closely about when the M&A or when the corporate activity starts, because presumably if prices are falling or share prices are falling as much as they have been lately, these explorers must be getting to a point where it makes more sense for the major to actually come in with a takeover offer than put the money into the ground themselves and start from scratch. Even though we're talking about a company that's next door, it must make sense at some point for the majors to deploy their cash in companies that have already done the work and have already got the results on the board, but those results just haven't been reflected in an appreciating share price. So, at what point do you think that starts? Is that something, do you think the majors are already looking at quite closely?
Yeah, as you say, the majors don't like exploration. They do it, but they don't like the risk. So generally, they prefer to take over a smaller company, one of these few explorers that can actually deliver on success, and that's when the major comes in. So there's different phases that a major might look at acquisition. And I think right now, with depressed prices for these junior mining stocks, it's certainly a strategic time for these big players to enter the market, and we're seeing signs of that, but it's not. It's certainly not to the levels that you would see maybe at the peak of a boom when the majors get a little bit overly excited and start paying too much and go all in. I
There's
suppose.
almost two phases, isn't there? There's the phase where the smart money comes in and buys at the bottom, and then there's the phase where there's too much money and there's just crazy M&A going on right at the top. And that's sort of, sometimes there's a M&A cycle that marks the bottom, and sometimes
Yep.
there's a cycle that marks the top.
Yep. No, absolutely. Yeah. So there's definitely evidence. I think what you'd call it a sort of a healthy level of M&A activity is in play at the moment.
Let's move on to a couple of commodities just by themselves. What's your favorite few commodities for the next few years? If you only had two commodities to choose to invest in for the next, say, 3 or 4 years, what would your picks be?
Okay. Well, that's hard because we are sort of, when we talk about secular bull market, it generally sees a sort of multi-commodity boom, and through that
Absolutely.
boom, you'll see these commodities ebb and flow. So one will take off, another one will decline. But and as I think you pointed out earlier, I think copper really stands out as the number one commodity for me. Um, when we talk about the energy transition and the need to electrify and move away from fossil fuels, copper is the one commodity that can't be replaced through changing technologies. I mean, we have wind turbines, we have solar panels, and now there's more commentary about using nuclear energy. So whichever choice governments finally sort of decide to adopt as a mainstream baseload power source, copper will be the commodity delivering that energy from the power source to the end consumer. Um, so it's that single use factor. It's that there is no replacement technology that can look for an alternative to copper. So I think that's why it is a key metal in electrification. Um, and then we also think about the supply side. So Chile, which is a major supplier of copper, and we've got declining output at the world's biggest copper miner, which is Codelco. It's a state-owned company, and falling output. I think this company is at risk of liquidation. I read from a report with Reuters. So it's these risks. It's the supply risk, but the strong demand outlook for copper is really strong. Um, Now I'll try to pinpoint one other commodity. I think rare earths is still really strong, even though it's had a terrible year in 2023. Um, it 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 isn't tied to just this green energy transition. It's also a really important metal for defense and tech generally. And then we think about where does all this supply come from, and it comes
China.
from China, which 90% of rare earths, and for global manufacturers, that really puts them in a difficult spot if we see any sort of ratcheting up in global tensions between the US, the West, China, and Russia. So um, this would be an event, I think, that would make rare earths sort of repriced in a sort of a pretty rapid way. Um, we saw China ban some critical metals, germanium, early in the year. So there's every chance we could see a ratcheting up as China sort of plays with the US in this trade war.
And you've got companies like Linus that's down nearly 50% from its peak, probably some of the most strategically important rare earths assets in the world. I know you look at a lot of the smaller players as well that are developing, given that Australia does have considerable rare earths assets throughout various regions in Australia. One other question I wanted to ask you on commodities. One of my favorite commodities, gold. What's your view on gold? I mean, gold's tricky because At the moment, it's got a bit of a geopolitical premium to it. It's rising, and I always think it's tricky trying to invest around these types of episodes. So, what's your view at the moment?
Yeah, I think gold really does have, like all commodities, it's got strong fundamentals. I think gold is a really good one to watch because gold often leads commodities more broadly. If you see a pickup in gold prices, then you might see other commodities start to follow a few months later. So I do watch gold really carefully for one of those reasons. Um, it's also, I mean, it's so tied to whatever happens in the US. So rising interest rates. So I think we need to see some evidence that the US is going to back down from its higher for longer. And I think that would be the catalyst that would really be the surge that pushes gold past that sort of technical $2,000 an ounce level. So I
And to
think
your point, gold being a leading indicator, I wouldn't be surprised if it makes that move before the Fed, formally
uh,
announces anything, because it is such, and I've seen it before. It is a very, in many ways, a sophisticated market, and it moves ahead of uh, interest rate moves. It'll move ahead of a recession, and it'll certainly move ahead of the rest of the commodity complex. Not all the time. Like, I'm not saying it
mm,
happens uniformly,
yeah.
but I think it is a really good barometer of global liquidity, US interest rate movements, real interest rates. And if gold does start moving up, preempting a down move in say, bond yields, then that would be potentially a catalyst for the rest of the commodity space to start moving higher as well.
Yeah, absolutely. I think gold, if we see that break above the 2,000 an ounce level, that will really be a positive sign for the commodity sector more broadly. So really, really key level to watch. And I would be looking at gold in terms of the explorers, just with the deep value on offer. The gold prices are still relatively high, but these explorers will probably gain quite substantially if we saw any technical break above that 2,000 level. So now's probably the time to look at the juniors in the gold space.
Is that what you're
Um,
seeing as well? Because I looked at the Aussie dollar gold price today, and it's near all time highs. It's over $3,000 an ounce. So the actual gold price that they potentially could get if they move into development production phase is quite attractive, given that the Aussie dollar is so weak against the US dollar. But is any of that priced in, or is any of that reflected in the junior end, or is the junior end being bombed out like all the other commodity sectors as well?
I don't think investors are pricing in the long term outlook or taking into consideration the supply issues for a lot of critical metals. So I think that's where the value is for investors. If you're looking at the larger cap producers, I don't think you're going to see the same level of appreciation. So I think those types of companies are more priced in. I think there's still decent upside for those bigger cap stocks as well. But if you're looking at long term multifold potential for increases in share prices, I think the explorers and the developers is really where the focus should be.
Well, mate, you've sort of just answered my final question. Now, the podcast is called "What's Not Priced In," uh, and you just answered it. So maybe just to
So
reiterate, what is not priced in the world of mining, the stocks that you look at? What don't you think the market is pricing in?
I think it comes back to those main commodities that I really like. So copper, if you're looking at copper explorers, they've been smashed in 2023. Developers. So if you're thinking about the long term prospects for copper, the supply issues and the demand from this once in a century energy transition, which is hugely ambitious, I don't think the market is taking all those factors into account at all for the junior mining sector.
All right. Well, I think we will leave it there. I look forward to maybe catching up again in another couple of months. Perhaps the catalyst to kick off the next leg of this bull market will have occurred, or maybe you still be in accumulation phase and picking out the little gems that are amongst the many other stocks that are probably never going to do anything, because there are a lot of stocks out there that are probably not going to go on to anything more and might not be able to raise the money to continue. But I'm sure you'll be using your expertise in the field to try to pick out those ones that might be able to go into the development or production phase, or even get taken over by one of the majors. So look forward to hearing more in the future, mate. And thanks for joining us on What's Not Priced In today.
Absolutely. Thanks, Greg, for inviting me along.
No worries. We'll see you next time, everyone. Bye-bye.
Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.